Ready, set, rally. Markets on a tear this year with the S&P 500 up more than 10% in just the last few weeks. Our Bob Pisani is down at the NYSE with more on this rally. Hey, Bob.
It's very impressive, Melissa. The market is in a slow melt-up that's leaving it, I think, vulnerable to overvaluation. The market internals have been just outstanding recently, many more advancing than declining stocks for several weeks. Buying interest is higher, selling pressure is lower, and volatility, the VIX has collapsed. It's at a 4-month low. The problem, as I see it, is valuation. Where are you on the 2019 earnings debate? That's all that matters right now. Strategists are divided between those who believe we are heading for an earnings recession, 2 straight quarters of negative earnings growth, and those who think we'll avoid that. This is not a trivial question. The last time we saw 2 consecutive quarters or more of declining earnings was in 2015 and 2016. Not surprised. The S&P was down 0.7% in 2015. That was the only down year between 2009 and 2017. Got your attention now? So right now, first quarter earnings are down to a measly 0.5% growth estimate, with full year estimates now down at 4.8%, half what it was 4 or 5 months ago. So if you're in that camp that believes the market will see only, for example, 4% earnings growth, the consensus right now, then the S&P is currently selling for a 16.1 multiple. That's a bit pricey for such low earnings growth. But if you think there will be 0 earnings growth, then the S&P is trading at a multiple of almost 17. That is really pricey for no earnings growth, considering the historic average is closer to 15 or 16, with typical earnings growth of 5 or 6%. Now, an additional issue is emerging as well. The revenues are strong, 6-7% in Q1, but earnings are going to 0. This implies that margins are under pressure, likely from higher costs associated with wages and material costs. It's another reason to be a bit cautious. Back to you, Melissa.
All right. Thank you, Bob. Bob Pisani. So who's in the camp of 0% revenue growth? Because that, as Bob had mentioned, really shifts how you think about PEs in this market.
Yeah, it does. I mean, we need to see that top line growth. If we don't see it, then you start actually pricing in what we think have been the adverse effects of all these global headwinds. We're talking about lower growth. So here's the thing. You know, we talk about all the mega caps. I know we're going to talk about some small caps. But
not mega caps.
Yeah. Okay. Think about what is the most economically sensitive thing, despite the secular shift towards online advertising. Advertising. We haven't seen an earnings recession yet. We haven't seen a recession. People don't think that we can see the top line go down in Facebook or Amazon or Google. It's likely to happen sometime.
The real irony is that you know, Wall Street in general holds out these models as being so efficient, and this is my DCF model, this is my enterprise value EBITDA, and yet there's been no change to earnings, and yet there was an earnings multiple collapse, and now we've had a re-rating of multiples. What is something worth? You know what it's worth? It's where it closes on the floor of the New York Stock Exchange in any given day, and it moves around so much that everything else is conversation. So is this just another chance to fade after a sell-off and a ricochet, or is something changed? The key issue is it's all about sentiment as much as ever before.
I think we've seen a lot of very conservative guidance out of a lot of companies. I've heard government shutdown being mentioned quite a bit, maybe not as much anymore, but I mean, that was like a significant portion of the earnings calls early on. I've also heard, you know, trade, and now I think that, you know, if we can get some sort of trade resolution, I don't know that we're going to have a comprehensive trade package, but if we can get some sort of resolution, Powell stays put, I do think we're going to see better top-line growth and better earnings growth than is being priced in right now.
I think it's what Bob had said. You know, you're paying a high premium on EPS that has just been declining. This has all been 100% PE expansion. So if you believe, as you said, that the China trade deal, if that winds up resulting in companies exploding with CapEx, then you want to be a buyer of the market. If you don't believe that that's going to happen, then we're paying a premium for earnings that just aren't there.
Right. Small caps actually beating the markets this year. And Carter called the rally back in December.
Every single time that we have come down and gotten this low, what's happened is that small caps have outperformed. And we are at that critical juncture yet again. You can see it. And what has happened here is this. And I'm going to make the bet that that is going to happen again, that we are going to actually have a double bottom on this, and we're going to have a major multi-point bottom on the percentage above or below.
Well, the IWM is up around 14% since then. But Carter says the rally has gotten ahead of itself. So why don't you head on over to the plaza and break it down?
It is a little steep. And remember, this is just getting into what's known as the January effect, that typically small cap stocks, if you subscribe to that kind of thing, will outperform, having been pressured at the end of the year. So it was a good year for January effect as a concept. But let's try to parse it out from here. SPY, IWM. I think the key is that, of course, you overshoot, that's the nature of beta to the upside, the Russell, and you undershoot, right? So cyclicality, smaller cap, lower quality in principle, the overshoot, the undershoot, they look the same, but what we really know is from the absolute low, from Christmas Eve, you've got the market, S&P up 16.1, and you've got the Russell up almost 20. And adjusted for beta, it's kind of what you might expect. But what's starting to happen here of late is an issue that I think can't be ignored. Here's the chart of the Russell. Obviously, it's a big move. And essentially, it's a little better than 50% back from the preceding sell-off. But as the rally continued over the past 2 to 3 weeks, watch what's happening on a relative basis. So this is the interesting thing. Over the last leg of the rally, relative performance to the SPY has started to stall. And not only has it started to stall, look exactly where it is stalled. It is stalled up against the relative downtrend line to the penny. I think this is an issue. I think the small cap move, as good as it has been, is likely at an end.
All right, so fade the small cap rally.
You know, when I think of small caps, I think of like a group that's pretty prominent in there, and it's energy. And I look at like the XOP, it's the S&P Oil and Gas ETF, and I look at the damage that was done. It literally got cut in half nearly in the last 6 months, and the bounce off the bottom is just bad. It's just not good. It's up maybe 25% after being down 50%. So to me, I kind of like to put those two things together here, and I just don't see it for that group. Especially Russell looks like it really hit some technical resistance.
And it's also heavy in financials, right? That's part of the issue. Financials have ricocheted so much, which has lent part of the initial torque off the low. But now it's starting to stall, and that is a problem.
Crude's starting to stall too. So you see crude flattening out as well. But when you brought up before, if your time horizon is longer than 6 months, you look at the XLE. So the XLE is up 11 or 12% year to date. You talk about energy, but look at it over 5 years. It's done nothing. It's down still 2%. Depending on how you look at it on a relative basis, it's down still 2%. So these are names where, yes, you could make that big bang for your buck. But as Carter said, if it's rolling over, these energy names get hit hard.
Small caps were deeply oversold in mid-December. They're borderline overbought right now. We saw a lot of small cap outperformance against the S&P 500 for about the first week of January. I think it's already stalled out. And when we look at the potential for higher wages over the course of the next year or so, we look at these companies have very high debt levels. We would expect that there's going to be underperformance in small caps the remainder of the year.